around this a notion of usage-based pricing over the past 18 or 24 months in the market. And for good reason. If you look at the chart on the left, which is Amazon's AWS revenue growing by year, there's been some pretty amazing, remarkable growth stories for companies that have this type of business model. By the way, that legend on the left is in billions of dollars. And they're not the only ones that have experienced rapid growth. There's been a number of very high-profile IPOs from companies over the past few years with really unbelievable net dollar retention rates and just about every other SaaS metric that you can think of being above average. So one of the reasons that investors and so many people are looking at this, just to oversimplify it, is subscription pricing, although it's been the most popular business model over the past 10 or 15 years because it provides a nice stream of recurring monthly revenue in a very predictable way. There are many that now increasingly believe that usage-based pricing, as evidenced by some of the logos I showed in that last slide, is a path to growing faster and getting more revenue per account in a shorter period of time. Now, here at Ordway, we're in the billing and revenue automation space. We're not a pricing consulting firm. So we like both of these models and think there's strengths and weaknesses of both of them. But the purpose of today's presentation is if you are considering usage, we want to make sure that you understand both the power and the complexity of this model. And that's what we'll spend the remainder of the session talking about. So one of the things that I like best about usage-based pricing is just there's so many dials you can turn and levers you can pull to precisely fine-tune the commercial arrangements that you have with your customers. There's so many different permutations for pricing and discounting models, different types of contract structures that you can arrange, different incentives and promotions to attract new customers or encourage them to grow, as well as policies that you can set up in the billing model to either offer more flexibility to the customer or to slightly increase your revenue. But with this power comes a lot of challenge and complexity. Implementing these usage-based pricing models does come with a considerable amount of additional overhead for almost every function in the business, from product and engineering to sales and marketing, customer success. But perhaps more than anyone, a heavy burden falls on the finance team, who has to figure out how to produce invoices for these complicated pricing arrangements, as well as do the accounting and investor reporting that's necessary. So we'll talk about how each of these different groups is impacted throughout the customer lifecycle as we go through. So let's start with designing the pricing for a usage-based pricing model. So as most of you probably know, there's a quite simple formula here that is used. At the end of every billing cycle, you determine the quantity of units that were consumed by each individual customer, and you multiply that by the price per unit to arrive at the line item charges that are on the monthly invoice. What's powerful here, though, is that there are an almost infinite number of options that you have for how you choose to measure quantity and how you choose to price things. So let me explain a little bit more about what I mean by that. On the quantity side, there are literally tens of thousands of different value metrics that cloud and SaaS providers are using to measure quantity of consumption. So one is the number of transactions that are processed. So you might see a company that's in the messaging space price based on the number of emails or SMS messages they send out. Time is another popular value metric, particularly in infrastructure and cloud computing, where you're often billed based on the number of hours or minutes you consume a service. Data is another popular model, particularly in networking and CDN applications, where you're billed based on the volume of gigabytes or terabytes of data moving through the system. And devices is a fourth model that you often see in IoT and some sectors of cyber, where your price is determined based on the number of devices that are being managed or monitored. But there's no reason you need to limit yourself to one of those metrics that I showed on the prior slide. Lots of companies are inventing their own custom units of measure to more precisely align the value that they're providing with the price that they're charging their customer. So we see this from Sumo Logic, Databricks, a lot of the unicorns out there that have grown quickly with usage-based pricing are using this model. Of course, as with anything new, you're going to have to invest time and energy in educating the market and expect that there'll be a bit of customer confusion negotiating the contract for any kind of new value metric. But you want to arrive at a nice, simple pricing table like this that you can display to your customers. So let's say that I had a cloud transcoding service where I took the raw output of a digital SLR and I can convert it into a nice high quality standard definition, high definition 4K video. I might want to have these standard list prices here, and I might want to also have some rate multipliers where I charge a premium perhaps for better service levels. So let's say, for example, that I return those video files in half the normal time, I might charge double the rate. So you also want to think about whether you want to have rate multipliers to charge customers differently based on what date or time it is, perhaps what geographic region they're in, whether they're getting access to something in a development, staging, or test environment, or a production environment. My favorite element of usage-based pricing is differentiating yourself by what you don't charge for. So what we call non-billable usage. So let's take a real-world example of that. Let's say that I had a marketing automation service, something similar perhaps to HubSpot or one of the Adobe products. Maybe I'm going to have a usage-based pricing model where I charge my customers based on the number of emails that they send or the number of contact records that they have in their database. I could choose to exclude any emails or contacts from the same domain, in other words, employees of that company, and not charge them. And if you were a larger company with 10 or 50 or 100,000 employees, that could amount to quite a significant amount of savings. So not only think about what you want to charge for, but what you don't want to charge for. Once you've got the pricing strategy defined, you then want to figure out what's the best way to package it up and present it to the customer. So if you have a lot of different SKUs and products, you might end up with something that looks like this, where you have a rate card, different rates for monthly and annual billing models. A real-world example of that might be if you were in the business of providing background checks for new employees that are being hired or onboarded. You might have a different set of rates for all the different public records that you could search for to make sure that the employee doesn't have a criminal record, or look at their motor vehicle violations, or verify that they in fact went to the university that they claim to, or worked for the companies that they claim to work for. Another common model that you'll see in usage-based pricing are pre-configured packages. So this is very popular in the cloud infrastructure space. So for different rates per hour, you get a different combination of CPU, memory, and disk space. And these are labeled much like what you would see apparel garments labeled. In fact, this is often unofficially referred to as the t-shirt size model. When it comes to business applications and SaaS applications, though, using a usage-based pricing model, this is by far the most popular, this tiered packaging configuration. And this should look somewhat familiar because this is a very common model used in the SaaS space. So it's very similar. With our pricing and packaging defined, we can now walk through the different phases of the customer lifecycle and talk about some of the challenges and opportunities that you have with usage-based pricing at each step along the way. So let's start with new customer acquisition. Much like in consumer subscriptions and B2B and SaaS, one of the more popular models to get customers to try a product is to offer it to them for free, either on a free trial basis for 30, 60, or 90 days, or on a freemium basis where they can consume a limited amount forever at no cost. But there's also some interesting new permutations that you can introduce when you start to move into a usage model. One of my favorites is this hybrid model where you can offer a freemium type of approach up to a certain number of units, let's say 100 a month. But once you're beyond that 100, you perhaps get billed $1 a unit for every additional one. So it's really a mix of freemium and paid. Most customers, once they start using a product and fall in love with it, will move off the free version onto a month-to-month type of pricing arrangement, perhaps with their credit card, where they're paying list rates published on the website to use the service and paying in arrears. Now, while this model sounds very appealing because you're only paying for what you use on a month-to-month basis and not locked into a long-term contract, we actually find that this is really only popular in about 5% or less of the use cases. So if you have a prototype or a short-term project that you're doing maybe for 3 or 6 months and you don't want to lock into a longer-term arrangement, this pay-as-you-go model can be very appealing. But most customers that are using the product on a long-term basis don't really like this model for 2 reasons. One, it's difficult to predict exactly how much you're going to get invoiced for every month, and so it's impossible to budget. 2, you're paying list prices for the services. You don't have a discount because you haven't negotiated a contract. Vendors don't much like this model either, this pay-as-you-go model. If you could just look at the charts on the right, you can see why, because recognized revenue goes up and down, and cash flow tends to lag expenses for 30, 60, if not 90 days. As compared to the traditional subscription model, the economics here actually don't look very attractive. With subscriptions, you've got a nice predictable stream of recognized revenue. You typically get paid all the cash in advance, at least 1 year's payment in advance. So the vendors don't much like this either. So both the customers and the vendors in 90+% of scenarios typically want to move to an annual contract structure that allows for more predictability on the customer side for budgeting, on the vendor side for revenue, typically requires some sort of commitment from the customer up front in the form of a down payment or prepayment that helps offset some of the expenses the vendors have. So there's a number of these annual contract structures. We're going to talk about 2 of the most popular ones. The first one is prepaid usage. And the idea here is that you have a reasonably high level of confidence that you're going to use 500, 1,000, maybe 5,000 units of a product over the next 6, 9, 12 months. And so you're comfortable pre-purchasing those units in advance as part of a contractual arrangement with a customer. And every month, as you consume usage, you will draw down against that prepaid balance until it's fully depleted. Now, there's lots of different ways to price and discount prepaid. And this is yet another example of the power and the creativity that you can use with these usage-based pricing models. So a simple model is just the more usage you buy in advance, the bigger your discount. But that is not the only way to do it. You could also incentivize people to use things in a shorter time frame. So, for example, let's say you were worried about Q3 revenue and you wanted to incentivize your customers to consume more of your service in the months of July, August, and September. What you could do is heavily discount prepaid credits that have a 90 or 100-day expiration window, which would provide an incentive for customers to buy those and consume more of your service and allow you to recognize that revenue in the near term. Now, while these things provide a lot of interesting opportunities for vendors, we do have to be careful and make sure that we're not setting the customer up for failure. When you set a 90-day expiration date, you want to make sure the customer is quite certain that they're going to be able to use that, because expired credits that were not used are really bad for you on a long-term basis. Although they might give you a boost in your gross margin in the short term, a customer that doesn't use the product is going to get frustrated and churn. Those are just a couple examples. They're really a much wider variety of discounting incentives. One of the more interesting ones are automated discounts, where the customer doesn't really have to negotiate anything in advance. The vendor automatically applies a discount when they hit a certain volume threshold or after they've been using the product for a certain number of hours in a month. Sliding scale discounts are another example. You might have seen these on websites where every incremental unit that you use, you get a slightly better discount. Sliding scales are less common. It's more common to see these types of tabular arrangements where there's a bracketed range of usage, and when you use 0 to 200 units, you pay $6 per unit. 201 to 400 is $4. 401 to 600 is $2, and so on and so on. But even here, there's a lot of creativity and flexibility that you can apply. So most of us would look at this chart on the left and say, well, if I'm using 600 units and they're each $2, I'm going to pay $1,200. But that's not the only way to compute this. There's another model called tiered pricing, where you would pay $6 for the first 200 units, $4 for the next 200 units, and $2 for the last 200 units, and in fact paying $2,400, or double what you would pay in that original volume model. So again, one of many examples of the power and creativity that you can apply here. And you can see in this chart, just comparing those 2 different calculation formulas, tiered versus volume, how much incremental revenue you can generate simply by changing the formula and the way that you compute the charges. The second popular contract structure is what they call monthly minimums. And as the name describes, this is where the customer commits to a certain amount of spend or a certain amount of consumption every month. Obviously, this is going to appeal to customers that have a somewhat predictable and steady repeated usage of the service over time. Vendors are going to love this, of course, because it looks a lot like subscription from a revenue standpoint, where you're getting a fairly predictable amount in every month. Important thing here to understand and make sure that your customers are educated on is you really want to pick the right monthly minimum and not be too aggressive. Because if the customer underutilizes, for example, with these orange bars in the chart, if they commit to 100 units per month and they only end up using 60 or 75 or 50, they still have to pay that minimum every month, which is going to result in a lot of frustration. Similarly, if they overutilize above 100 units a month, there's typically an overage charge, which might even be at a premium where they'll have to pay the additional 20, 40, 30 units that they used above the 100. So it's extremely important for the sales organization to work closely with the customer to accurately forecast how much consumption they're going to have on a realistic basis, because both over and underestimating will result in a negative customer experience. You also not only want to think about the sales team's forecasting with the customer, but how you're going to pay and incentivize the sales team. So sales compensation for usage-based pricing can be quite complex because you often don't know the amount of revenue that you're going to get from a contract when it closes. And unlike traditional SaaS and subscription models, only a fraction of the payment is typically collected up front. So you want to make sure that you're estimating the right amount and fairly and accurately compensating the sales rep for it. But you want to make sure the sales rep isn't incentivized to get the customer to overcommit, which will result in them being frustrated and possibly churning. You really want to incentivize them to build long-term relationships that allow the customers to grow over time. So there's lots of different ways you can calculate the amount of commission you would pay a sales rep. Some companies will forecast what the customer is going to use or what they think they're going to use over the contract term and pay on that. Others will only pay on what the minimum contractually committed amount is that the salesperson's able to negotiate with the customer. The obvious omission here would be if the customer uses more than they committed to. There's no upside for the sales rep in that. Others will pay on the actual consumption, which of course gets complicated because you don't know that until after they've consumed it, which could be well into the contract cycle on a monthly basis. And some will even calculate a run rate, so the average over a 6, 12, 18-month period to use for commission. So lots of different options there. So once you've got the customer signed up using prepaid or monthly minimums, a sliding scale, volume, tiered pricing, perhaps rate multipliers, then the easy part begins, right? You can sit back and just watch them use and watch them grow and adopt the service. Well, not so fast, because as you might be a little bit confused through all the examples that I've gone through, customers are also confused. And when they start getting invoices with overage fees and things that have expired, it starts to result in a lot of questions. And if you're not careful, this can create quite a bit of friction in the relationship that fosters an air of distrust and suspicion. It can slow down payments. It can delay sales cycles and just overall bring down the customer experience. So you really want to get out in front of this. And there's a couple things that you can do. One is, thinking about providing more detail on your invoice instead of just having one line item with a, $13,000 charge. You might want to show the actual formulas and calculations and how you arrived at that charge and the rating tables that are associated with it. A lot of customers actually want to see the details behind. You say that I used 10,000 units of this product. Well, show me the dates and times, the actual users that did that. And so they'll want that in a spreadsheet format that they can pull in and run pivot tables and do all sorts of analysis on. It's important to not only give the information to the customer, but also to your internal points of contact, right? Because who's going to get the nasty Slack or email or phone call from the customer when they don't understand their bill? It's likely someone in sales or accounts receivable or customer success, and they need to be armed with that same level of detail to help the customer understand what they're paying for and their actual consumption. Now, we talked about the problems that can arise with billing, but we didn't really talk much about how the bills are generated. And so every month there's a rather complex process that needs to occur here where you're pulling the actual usage detail records out of your SaaS or cloud product. You're binding them up to which customers use them and putting them in a format that can be uploaded to the billing system, which is then going to go through a rather complex process of rating, factoring in all these prepaid balances and monthly minimums and volume and tiered and sliding scale prices and freemiums and rate multipliers and all these sorts of things to arrive at an invoice that has the appropriate sales tax, VAT, GST in the appropriate currency for the customer. And you might be surprised to learn that although there are hundreds of billing vendors on the market, there's very few that actually support this type of pricing arrangement. And so what's become quite common among high growth companies is they build their own billing systems. So they take 20, 30, 50, 60 engineers and develop their own billing system. One of the other big things that finance needs to do is to figure out how to report this in an intelligible way to the investors. So a lot of the familiar metrics we're used to in SaaS and subscriptions, like ARR and churn and ACV and customer acquisition cost and net dollar retention, investors want to see these same types of metrics for usage-based pricing. Except the big problem is there's not any kind of common agreement on exactly how to calculate these for a usage-based pricing scheme. So here's a simple example: recurring revenue. Well, let's say you had these 6 customers on usage-based pricing model. Do any of these look like recurring revenue to you? Perhaps number 5, but the others don't. But if you add them all together, you'd be surprised that they often do sort of flatten out into what appears to be a relatively predictable, stable base of revenues, particularly as you get a larger customer base. And there are ways to annualize and compute these things. To further complicate matters, there are a whole set of additional metrics that investors want to see around usage-based arrangements, like what percentage of your contracts and customers are with month-to-month pay-as-you-go models versus annualized contracts. What are your remaining performance obligations, which are, effectively deferred revenue backlogs? And perhaps most of all, but not listed on this chart, if you look at the investor filings and investor presentations of big public companies, one of the things investors like most about this model is how you can grow existing accounts by getting them to use more products. And so one of the common things you'll see in public company presentations is the number of customers paying over $1 million or 100,000 per year for product. The number of customers that are using not just 1, but 2, 3, 4, 5, 6 products from a particular vendor. So, of course, the way that you do that is with a land and expand strategy, and this is going to fall on the sales and customer success organizations. Typically, with usage-based pricing, someone in one department starts off with a freemium model, falls in love with the product, tells their teammates about it. Next thing you know, a whole division is using it. But the sales and customer success team are going to need to carry that message on to all the different business units and product lines in the company to try to encourage widespread adoption. Not just in one country, but throughout the Americas, Europe, Asia Pacific. If it's a big global multinational organization, you're going to want all the different business units around the world using this. And over time, as you grow, you're not going to have just one product, but you're going to have 2, 3, 4, 5, 6. And you really want your customer to commit to using your platform and offer them discounts and incentives to use not just 1, but 3, 4, or 5 of the products. And that's what really gets complicated, because each one of these business units using all these different products want to get their own invoice at the end of the month that has an itemized listing of what they used and what their prepaid balances are, what their monthly minimums were, their pricing tables. And of course, they want that all presented in a unique invoice with the appropriate VAT, GST, sales taxes on it in the appropriate currency. So as you can see, this can be quite powerful, but also quite complex. So I'm going to pause here.